In the textbook that I base this course on, Personal Finance, Turning Money into Wealth by Arthur J. Keown, he talks about how risk and return go hand in hand. Well, that has some validity to it. I would argue that is not necessarily true. I think a more accurate statement would be that risk and ignorance go hand in hand. As one of the best investors, Warren Buffett, says, risk comes from not knowing what you're doing. I'm not saying there is completely no risk when you know what you're doing. Every action you take involves a certain level of risk no matter what you're doing, regardless whether it's investing or not. There's always going to be some variable you can't account for. What I'm saying is that the more you know, the less risk you incur when you take action. I don't have time in this course, but in some of my future courses, I will show you how to severely decrease risk by doing research and picking financially healthy companies. I'm going to also show you how to reduce risk through diversification. You're going to learn what steps you need to take to eliminate risk without affecting potential return. There's no question that you must accept some risks to meet your long-term financial goals. So you must balance the amount of risk you're willing to take on the amount of return you need. In the next few lessons, we're going to examine the different sources of risk in investment, starting with interest rate risk. One source of risk to investors finds its roots in changes in interest rates. Regardless of their source, interest rate changes can be bad news for investors. For example, when market interest rates rise, the price of outstanding bonds declines, because new bonds with higher interest rates are now available. No one will want to buy your $1,000 6.5% 10-year bond when $1,000 8% 10-year bonds are available. The higher the interest rate climbs, the less your bond will be worth. The same basic relationship holds for common stock. When market interest rates rise, the price of common stock drops. That's because alternative investments such as bonds are paying more when interest rates rise, and that makes stocks look less attractive to them in a relative sense. This fluctuation in security prices due to changes in the market interest rate is a result of interest rate risk. Unfortunately, because increases in interest rates affect all securities in the same way, it's impossible to eliminate interest rate risk. Inflation risk reflects the likelihood that rising prices will eat away the purchasing power of your money, and the changes in the anticipated level of inflation will result in interest rate changes, which will in turn cause security price fluctuations. Inflation risk is closely linked to interest rate risk, but it is important enough in the valuation and investment processes that it's generally treated as a totally separate source of risk. Most stocks and bonds are influenced by how well or poorly the company that issued them is performing. Business risk deals with fluctuations in investment value that are caused by good or bad management decisions or how well or poorly the firm's products are doing in the marketplace. Business can go bankrupt and management does make poor decisions. Look at Amoros, the biopharmaceutical firm. On April 1st, 2011, its stock tumbled by 38% after one of its experimental drugs failed in the late-stage clinical testing. Business risk is different for different companies. Some companies seem to post even profits year in and year out, regardless of what's happening in the economy, while the profit levels of other firms tend to swing wildly. Financial risk is risk associated with the use of debt by the firm. As a firm takes on more debt, it also takes on interest and principal payments that must be made regardless of how well the firm does. If the firm can't make the payments, it could go bankrupt. Thus, how the firm raises money affects its level of risk. Political and regulatory risk results from unanticipated changes in the tax or legal environment that have been imposed by the government. Changes in capital gains tax rate or in the tax deductibility of interest on municipal bonds, or the passage of any new regulatory reform laws affect investments' values and are examples of political and regulatory risk. Call risk is the risk to callable bondholders that a bond may be called away from them before maturity. Calling a bond refers to redeeming the bond early, and many bonds are callable. When a bond is called, the bondholder generally receives the face value of the bond plus 1 year of interest payments. Exchange rate risk refers to the variability in earnings resulting from changes in exchange rates. For example, if you invest in a German bond, you first convert your dollars into euros. When you liquidate that investment, you sell your bond for euros and convert those euros into dollars. What you earn on your investment depends on how well the investment performed and what happened to the exchange rate. For the international investor, exchange rate risk is simply another layer of risk. Liquidity risk deals with the inability to liquidate a security quickly and at a fair market price. For investments that are infrequently traded, it can be hard to find a buyer. Sometimes it's impossible to find a buyer at a fair market price, and you wind up having to sell for less than an asset's worth, sometimes even for a loss. Buying a piece of your favorite sports team has long been a popular investment for the super rich. But there's a good deal of liquidity risk in such a venture. Harvey Lighton, owner of 3.1237% of the New York Yankees, learned this lesson when he took out a newspaper ad offering a 1% stake in the Yankees for $2.95 million. There were no takers. He then considered a plan to take a 2% stake in the Yankees and divide it into 20,000 pieces, each representing 1/1,000,000th of the team, and sell them for $500 each. That didn't work either. For investors who need money fast, liquidity risk is an important consideration. Market risk is risk associated with overall market movements. There are periods of bull markets, that is, times when stocks seem to move upward, and times of bear markets, when all stocks tend to decline in price. The same tends to be true in the bond markets. This is what happened over the 2007-2008 period, when stocks dropped 40% from their all-time highs just 1 year earlier, with virtually all stocks dropping in unison. This lesson was pulled from Personal Finance, Turning Money into Wealth by Arthur J. Keown, a textbook that was part of one of many finance courses I took in college. If you found this episode helpful, please give it the thumbs up and share it with your friends. If you feel inclined, please like us on Facebook, subscribe to our YouTube channel, follow us on Twitter and Instagram, and if you really want to, subscribe to Gennecho's weekly newsletter. We will give you all sorts of advice, tips, and strategies to all things finance and investing. Just click the link below and enter your name and email in the form provided. Thank you so much for watching and have a great day.